Hello and welcome to Edison TV. I'm Miłosz Paps, Director of Investment Trust Content at Edison, and today I'm joined by Alan Gauld, who's Senior Investment Director in the Patria Global Private Market Solutions team and the lead portfolio manager of Patria Private Equity Trust. Alan, great to have you back on Edison TV.
Thanks for having me, Milos.
Patria Private Equity Trust has recently reported its FY25 results. Before we delve into the details and key highlights of these results, perhaps you could reiterate the key attractions of the trust to those listeners who are less familiar with it. Specifically, maybe you can talk about why the trust may be a good chance for retail investors to in their asset allocation and diversification.
Milos, well, taking a step back, Patria Private Equity Trust, or PPET, is like any listed private equity trust. You're able to access it for as little as the price of the share, and there's daily liquidity via the stock market. So it kind of gives retail investors the best of both worlds, insofar as they get access to private equity, a strong performing asset class over the long term, but relatively illiquid. But in this structure, it provides that liquidity, that ability to trade in and out like any listed stock. If we turn to the trust specifically, so Patria Private Equity, or PPET for short, it's formerly known as Aberdeen Private Equity Opportunities, and prior to that, Standard Life Private Equity. It's been around for almost 25 years. It IPO'd in 2001. And it provides, throughout that time, it's been about providing access to some of the best opportunities in the private equity mid-market. So what we mean by mid-market is basically private companies between 100 million and a billion enterprise value at entry. So we're talking about established businesses that are cash generative, profitable businesses, growing businesses, but where a private equity partner can help accelerate their growth and maturity, shall we say. So the trust makes both fund investments and direct investments into private companies as well. It partners with a small group of private equity firms, leading private equity mid-market firms. At last count, our core manager relationships were 17. And the trust, in terms of other specific features, it pays a quarterly dividend. So that dividend's around about a yield of 3%. And the dividend has grown every year for the last 11 years. So now it's an AIC next generation dividend hero. And there's a commitment from the board to maintain the value of the dividend going forward in real terms. In terms of costs, it's a simple fee structure. It's a flat 95 bps management fee. Most private equity vehicles have a management fee and a performance fee on top. We don't. So when performance is particularly good, that flows through to shareholders. And performance, I think this is a key thing here. This has been around a long time, 25 years, as I said. If we look over the last 10 years, the annualized NAV total return of the trust is 14%. If we look over the last 25 years, or back to IPO in 2001, the annualized NAV total return is 11%. And in 2025 marked 16 consecutive years of positive NAV total return growth, which we're really proud about.
Great. Thank you for this introduction to the trust. Maybe you can tell us more about the recent underlying top line and EBITDA performance across your portfolio companies and how this has been driven by your sector allocation.
Yeah, no problem, Milos. So in Patria Private Equity Trust, we have around about 650 underlying private companies in our portfolio. So it's pretty diversified. So if we look at the top 100 companies, which is around about 60% of the portfolio NAV. So revenue growth in the last 12 months averaged around 12%, and earnings growth, EBITDA growth, over the last 12 months averaged around 13%. So the businesses are continuing to steadily grow on average, which we're really pleased about. And it's a continuation of what we've seen over the last few years as well, which is great. If we link that to your question around sector exposure, we're not really trying to take too much exposure in certain places. We want a balanced portfolio by sector. We typically like non-discretionary type sectors, business to business in a lot of cases. So when we look at our sector exposure at the financial year end in 2025, we had information technology and healthcare at 23 and 22% of portfolio value, respectively, then followed by industrials, which includes some business-to-business professional services companies. So that industrials was around 17%. And we had consumer, both consumer discretionary and around 12%, and consumer staples at 11%. Financials, typically asset-light financials, think insurance brokers, etc. That was around 8%. We've got very, very little in relation to sectors that are linked to commodity pricing. For example, energy is 1%, materials is 4% of the book. So it's pretty well balanced, sort of more towards non-discretionary type sectors. So that helps create that steady underlying performance in the portfolio.
Excellent, thank you. And I think in this context, it's worth discussing the improving private equity market environment. We've seen in the second half of 2025 a significant rebound in both transaction and exit activity across European private equity. And you've also highlighted during your results that you've seen some notable exits agreed in FY26 so far, with examples being Uvesco, G Treasury, or Intelerad. So maybe in this context, can you share your views on the outlook for 2026 and how the trust is positioned in this respect?
So you're absolutely right, Milos. We saw a real acceleration in realizations over really the last quarter, even following the financial year end. So if we look at calendar year quarter four of 2025, our realizations totaled around 61 million, which is almost double what we saw in the quarter prior to that. So we're starting to see that real pickup. There was this real disruption in the first half of 2025 due to the US tariff rhetoric and the uncertainty caused by that, which wasn't helpful in terms of private equity deal flow and ultimately exits. And it's worth reiterating that exits are the lifeblood of private equity, because when an exit happens, you receive cash distributions that allows you to reinvest in new opportunities. So the more exits you get, the faster the wheel moves, and exits have been probably the key issue in private equity since interest rates rises in 2022. We're starting to see that pick up, and as you know, we saw some interesting signed deals in the last 3 months. You mentioned G Treasury alongside HG. We've had EVAC with Bridgepoint, and you noted as well Uvesco, which is one of our direct investments. Actually, at year end, financial year end, it was the 4th largest portfolio company in our book. And so that has been subject to a sale agreement with a consortium of Spanish investors agreeing to buy that business from PEI partners and its co-investors like PPET. So that one will likely close by the end of the first quarter of 2026. So that'll result in good proceeds back to PPET. And we're hopeful that that's a sign of things to come. I mean, if you look at the second half of financial year 2025, our NAV total return was 7.9% over that 6-month period. So you should never extrapolate things going forward. And I know you're asking about the outlook for 2026. But if that sort of momentum was to continue, we'd start to see returns back in that sort of mid-teens NAV total return space, which should be really good. So look, all bets are off if things happen in the broader market. We didn't see the US tariff discussions and rhetoric coming around in 2025, and that caused a pause and a delay in a lot of M&A activity. But if we have generally relatively stable markets in 2026, that will provide backdrop for private equity M&A activity, for private equity exits. The early signs are good, as I said. So hopefully we can see those more stable conditions, and that will help PPET drive performance across the year.
Perfect, thank you. These are definitely encouraging developments. So now, in the context of this improving outlook and maybe also the close to £100 million of deferred consideration you recently received from the secondary sale you did back in 2024, maybe you can talk us through the future asset capital allocation, right? In terms of primaries, secondaries, directs, repayment of the credit facility, dividends, and buybacks.
So we're great believers in certainly in the private equity market and staying consistently invested through the cycle. So as you know, Milos, in private equity, sometimes you get good vintage years where the pricing is lower and the competition is less intense, and then you get less good vintage years, typically when pricing is higher and competition is fierce. And so good examples of that, perhaps, more recent years, the sort of less good vintage years would be the likes of 2007, where a lot of things were bought ahead of the global financial crisis at lofty valuations. We think 2021 might be in a similar vein. But equally, right now, we think could be quite interesting vintage years when we look back 5 years from now, because pricing is more moderate and there's less competition in the market. There's more time to do due diligence on the asset. So you want exposure through the cycle, so you pick up exposure to these stronger vintage years that typically occur following a market dislocation or market event. So to answer your questions, we look ahead, we want to keep making investments as we look to 2026 and 2027 and beyond. So last year we made new investments around 300 million sterling. We will likely do that again in a similar number. And when you break that down into the components as you set out, into primary funds, secondaries, and directs, you look at our exposure at the moment, we're about 63% of portfolio value held through primary funds, around 9% through secondaries, and around 27% through directs. We want to increase PPET's exposure to secondaries and directs that little bit more. Primaries will always be the sort of core of the portfolio, but directs, as we know, provide access or more concentrated access to some of our conviction picks in terms of portfolio companies, and importantly, typically come with no fee or carried interest attached. So they're lower cost. So if you get it right, you get your selections right, you appropriately diversify the direct portfolio, they should perform better than primary funds. And then secondaries, from a risk return point of view, are really attractive because you're typically buying companies or funds from another investor part of the way through their holding period. So the payback is quicker. The risk return dynamic is much different as well. And they add something interesting to our portfolio too. So we want to just keep investing, keep increasing the exposure to secondaries and directs. And then more broadly, outside of investments, we'll continue to grow that dividend going forward, at least in line with inflation. And then we'll continue to opportunistically buy back PPET stock too, and create that additional NAV accretion to existing shareholders. And then lastly, in terms of gearing, I mean, we're around about 10% of net assets in terms of gearing. And, personally, as the lead manager, I'm quite comfortable with that level. Obviously, if there's a pickup in exits in the market, there would be the ability to de-gear. And at the moment, around 62% of our portfolio value is held in assets that have been held for 4 years or more. So in theory, those types of investments that should be approaching exit, that could underpin a good, strong cash flow in the years ahead if market activity really comes back. And that, as I say, would allow us to de-gear. But as I say, around 10% gearing, I think.
Thank you. I would like to conclude our conversation by asking you the following question. How would you convince an investor that the current discount to NAV at which the trust is trading is an attractive buying opportunity?
Well, PPET's been around a long time, as I said. It's been around for 25 years. It's delivered for shareholders throughout that time. If you'd invested at the start and reinvested your dividends, for example, you'd have made around 10 times your original money. So it's been around a long time, has a strong track record. Its mid-market strategy, I think, is really interesting because you're typically in the mid-market buying companies from families, or you're partnering with founders, or you're carving out a business unit from a large corporate. It's investments where there's a genuine ability to create value or alpha. There's literally thousands of these types of businesses where good quality private equity firms, the types of firms that we partner with in PPET, can really help company management accelerate growth and therefore generate strong investment returns through the cycle. So looking at PPET right now, its share price discount is wider than the longer term average, and considerably so. But even if you assume that that discount doesn't close, the long-term annualized NAV total return, the 10-year annualized NAV total return is 14%, as I said earlier. Since inception, it's 11%. So even if you assume that that discount doesn't close, you can write that NAV going forward. I mean, it's 16 consecutive years of positive NAV total return growth by PPET. So it tends to grow through the cycle. And in addition, there's that quarterly dividend, that regular yield as well. And as I've mentioned today, I mean, 2025 saw a pickup in performance, certainly the second half of 2025, once the US tariff noise had dissipated somewhat. And there's signs that momentum can continue into 2026. And if that's the case, then I think private equity trusts or investment companies like PPET will see their performance further accelerate, and these trusts will become more popular and more in demand, and have the potential to see some narrowing of the share price discount. So yeah, hopefully I've compelled some retail investors that it's quite an interesting time to buy.
Alan Gauld, lead portfolio manager of Patria Private Equity Trust. Thank you very much for this detailed conversation.
Thanks again for the invite, Milos.